Hi there, welcome back to the course. In this section, we'll talk about how to analyze financial statements and how news events and data releases affect the stock market. Let's get started. Analysis of financial statements. As an investor, you should know how to play with numbers. When you get started in the stock market, you should know how to analyze and interpret a company's financial statement numbers. You can learn a lot about the performance and prospects of a company by analyzing its financial statements. The three aspects that you should look into when analyzing a company are the company's income statement, the balance sheet, and the cash flow statement. These three financial statements will help you understand the company's functioning, the stability of the company, and the worth of its stock. So, let's understand how you analyze these three financial statements. The income statement, or the statement of operations. Now, this is one of the three most important aspects of a company's financial statement that you need to understand in order to see a company's financial performance for a specific accounting period. On some websites, you might see an income statement is referred to as profit and loss statement, or the statement of revenue and expense, so don't get too confused. When you read an income statement, you gain insight into the company's operation, the efficiency of its management, underperforming sectors, as well as how it's performing compared to its industry peers. Now, the income statement focuses on four key aspects: revenue, expenses, gains, and losses. What it doesn't focus on is differentiating between cash and non-cash receipts. Cash and non-cash receipts simply mean sales in cash and sales on credit, respectively. At the very starting of an income statement, you would see the details of sales, and as you go downward, the income statement works its way through to calculate the net income as well as the earnings per share, or EPS, at the end. In retrospect, an income statement tells you a story about the company through the use of numbers, and the numbers tell you how the company managed to transform its net revenue into net earnings. We'll be able to better understand this with the help of an example. The above table is Netflix's income statement. Now, focus on the last column, i.e. 12 months ended December 31, 2020. This column provides you with the whole information for the year 2020. We can see total revenues of $24.99 billion. The following four items are the expenses incurred to earn this revenue, and after deducting those, we're left with an operation income of $4.5 billion, followed by deducting other expenses such as finance cost and income taxes. We're left with the company's net income, which is $2.7 billion in this case. As you can see in the table, income statements also show EPS at the end, i.e. the earnings per share of the company. That's net income and outstanding shares, which is 6.26 for Netflix. Focus on the basic EPS for now, as diluted and weighted average EPS comes under advanced financial statement analysis. Balance sheet. A balance sheet gives an account of a company's assets, its liabilities, and shareholders' equity in the company at any given point in time. This financial statement is no less important than an income statement. And while an income statement gives you an account of the company's revenue and expenses for a particular period, the balance sheet provides information on what the company owns, what it owes, and what amount is invested by the shareholders. When assessing a balance sheet, you would notice that the asset side always equals the liability side, because the formula used for creating a balance sheet is assets equals liabilities plus shareholders' equity. Again, let's take the example of Netflix to understand this concept a little bit better. Focus on the first section of the table above. It shows us the breakup of assets, which sums up to $39.28 billion, which is the left-hand side of the general equation that we talked about. Then come liabilities divided into short-term and long-term, which totals $28.21 billion. At the very last, we're provided with shareholders' equity, which gives us another $11.07 billion. For the moment of truth, on the right-hand side, if you calculate the total, our sum would equal the value of assets, i.e. 28.21 plus 11.07 for 39.28.